Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today we welcome back our friend, Cox Senior Economist Charlie Chesbrough. Charlie, you've kept us up to date all year with your quarterly reviews, so I'm interested in what you have for us today. I hear there's some good news, so I'm going to let you take it away.
All right. Well, thank you to everybody for joining us today. We're going to give you the vehicle market update, and I've titled this Where We've Been and Where We're Going, because it's really been quite a roller coaster for 2021. And unfortunately, that roller coaster is likely to continue, but I think at least we can say we're more on the heading up another hill as opposed to heading down into a trough. And I think that that's the situation we have right now as we're finishing up 2021. A couple of topics I want to take us through today, give you an update on the status of the U.S. economy. And I think really the only way to describe it right now is hot and getting hotter. And that's really what we heard from the Federal Reserve at their meeting yesterday. And I'm going to talk a bit about that, about what's coming in terms of monetary policy. Talk about the vehicle market update, as I said, where we've been and where we're going. It's been a crazy year this year, but all the indicators suggest that we are going to see stronger sales in 2022. Give you a quick update on the used vehicle market. This is really where we're seeing inflation run wild out there, and it's been a major contributor to inflation from the measures that the government uses. To give you a quick update on what we're seeing with prices. And lastly, I want to talk about electric vehicles, because ready or not, here they come. I think 2022 is going to be the first of many big years for electric vehicles. And I just want to take you through some of the issues that we're going to have surrounding them. So let's start by talking about COVID. Unfortunately, we can't really talk about any update until we get an update about what's going on with the virus. Unfortunately, a lot of the indications suggest that we are going to see a surge here over the next couple weeks. As everyone gets together during the holidays, we've already seen a surge post-Thanksgiving. That's likely to continue in through December. This Omicron variant, I guess, is more contagious, but it makes you a little less sick. I guess that's the best I've heard about it so far. But we can see on the left here that cases are starting to rise. I'm based in Michigan, and actually we're number one, not only in the BCS, but also in new COVID cases. So unfortunately, we're seeing it run wild here, and we're hearing a lot of hospitals are getting overrun, particularly on the west side of the state of Michigan. On the right here is vaccinations. We are seeing that vaccinations are starting to rise again. The mandated vaccinations appear to be having some effect, as a lot of municipalities around the country have mandated that their workers get vaccinated. That certainly helped. From what I've read on the latest, only about a third of folks have actually had the third dose just yet. And that's really the one that I think everyone is expecting we got to get to for the majority of folks out there to get this virus under control. But in terms of its impact on the vehicle market, it seems like the virus itself is going to have very minimal impact on vehicle sales. We're not going to see any closures out there. People who are concerned about the virus, I think there are fewer and fewer of those folks that aren't willing to go on with their lives, at least with a mask on, and get out there and start shopping for vehicles. And what we're seeing from the economy is that it's still looking very strong itself. And this is looking at quarterly economic growth over the last 20 years. I put this history on there just to give you a perspective of what we've gone through during this COVID period. On the far right, you can see the decline of economic growth that we saw in the first quarter of 2020, and then just the massive decline in the second quarter, 31% of the second quarter of last year. And then we had the rebound in the third quarter. And since then, we're seeing economic growth rates that have hovered in the 4 to 6% area. But we can see that in our most recent data point from the third quarter, that Delta variant really took a bite out of summer activity. And we saw economic growth pull back again. The expectation is that we're going to see economic growth a little bit muted because of these viruses and the new Omicron variant, but it's still going to continue on the right path towards expansion. And where we're really seeing the squeeze out there in terms of the strength of our economy is in the jobs recovery. This is looking at the unemployment rate going back to 1950. So really 60 years worth of data here. And again, I just wanted to show the perspective of what we all went through in 2020. The unemployment rate spiked to historic levels, but it's been coming down rapidly. And we just got November's unemployment rate numbers, and they last week, and they came in at 4.2%. So we're getting very close to pre-pandemic levels for the unemployment rate. But it was a little bit of a disappointing number in November. We were expecting close to 600,000 jobs to be created. Only a little over 200,000 jobs were created. And the biggest factor there was hospitality and the restaurant industry, where this new variant forced many more layoffs and closures of restaurants. So, this virus is going to hit certain sectors of this economy indefinitely, and certainly anything related to services is going to suffer almost immediately. Where there's optimism out there is because there's a lot of money that's saved up from consumers that's waiting to be unleashed on the U.S. economy. On the left here, I'm showing the personal savings rate. And this is whatever your income is minus whatever you consume, and then the rest is measured by the Federal Reserve is called your savings rate. What percentage of your income you're essentially putting in the bank. And I've got data here back to 1960, again, 60 years worth of data. And you can see that this has been a fairly stable number through time. In the 60s and 70s, we were saving much higher percentage rate, closer to 10 to 13%. During the 2000s, this fell to a 5% rate. And you can see what's been going on during COVID. When the crisis really hit, consumers pulled back from the market significantly, and savings rates really, really spiked. And all of that money of people pulling back from consumption has contributed to this figure on the right, which is accumulated pandemic deposits. This is essentially the amount of money that's accumulated in savings accounts. In addition to what consumers have saved, it's also a lot of money from the government, from all of the stimulus programs that we've had over the last 2 years. A lot of it has contributed to these deposits. And so we know consumers are flush with cash out there. And the idea is that this money will be unleashed on the U.S. economy, and that's going to lead to very, very explosive growth next year. And that's why a lot of folks are concerned about inflation coming. The Federal Reserve spoke yesterday and really signaled that they are really concerned about inflation. When they met back in September, the Federal Reserve governors all said that none of them expected any interest rate increases in 2022. They met yesterday and they voted in as a majority that they think that there's going to be interest rate increases. And at this point, the consensus out there is as many as 3 quarter-point increases. So all of these interest rates I'm showing here on this slide, which were down on a year-over-year basis, the outlook for 2022 is that's no longer going to be the case. We're going to start to see interest rates rise next year. So this is going to be the biggest change in the economy in 2022. That means those auto loans are going to get a little bit more expensive. Those mortgages are going to get a little bit more expensive. And all of that is going to be a negative impact on vehicle sales. Now, how much of a negative impact, that's really hard to say right now, because really when you're talking about a quarter point or even a half point increase in the interest rate, you're talking about $10, $20 maybe on that monthly payment. It doesn't help, but I wouldn't say it's certainly going to detract any serious vehicle buyer out there from pulling back from the market. But again, this is going to be one of the changes that we're going to see in 2022. And consumers are very concerned about inflation. And that's one of the big things that's been holding back this economy from being even more robust than it already is, and why that pandemic savings has not been spent yet. And this is one of the factors that consumers are looking at that's causing them to take pause. Gas prices. Gas prices have been up tremendously since the bottom of this crisis. So we go back to the very beginning of May of 2020. Prices are now up 88% from where gas prices were then. We are now back at highs that we haven't seen for gas prices since October of 2014. And so this is a big factor for consumers, because nothing stares at them in the face about the cost of living and cost of living increases that when they have to fill up that gas tank once or twice a week and spend a significantly larger amount of money. So this is one I think that, and politically, I think this has really been detrimental to President Biden as well. The prospects for this, it's already come down a little bit. We've seen gas prices pull back in recent weeks a little bit, but they still remain elevated. And this is certainly one of the issues that folks are concerned out there about. All of this plays into consumer sentiment. This is the measure that we like to watch, that's sort of the overall, what is the level of optimism out there in the U.S. economy. This is from Morning Consult. They talk to thousands of people every day to get their views on what they see out there. And I think this slide is really kind of interesting because you can see on the far left here, this is going back to January of 2020, when we fell off a cliff in terms of people's optimism when COVID struck. We've seen a nice recovery of optimism through the spring of 2021. And then we can see this Delta variant hit, and it really sent us backward. And we can see that people started to pull back on their level of optimism. And all of this contributed to that weaker economic growth that we saw in that third quarter. And so here we are, where things are a little bit better from where we were in the worst of the crisis, but it's not that much better. We're still down about 20% in terms of the level of optimism out there from where we were prior COVID. This is a metric that should improve this year as we see more vaccines spread and hopefully inflation pulls back a little bit. But I think it's certainly one to watch that may be one of the hiccups to our recovery. And I've shown you guys this slide before, but I still think it's very, very interesting. Within that consumer sentiment on the slide I just showed you, you have urban people, you have rural people, you have rich people, you have poor people, and you have Republicans and you have Democrats. And how people see the world is really depending on, whether they see the glass as half full or half empty. And I bring this slide up because when we look at consumer sentiment by political affiliation, on the surface, we've seen a little bit of change in this post-COVID market, but not much. It's been a fairly stable a level of confidence out there, and that's what that purple line is. But underneath it, folks, depending on how they identify politically, have seen a massive change in how they see the overall economy. In February of 2020, Republicans' sentiment was 47 points higher than Democrats. And on our most recent data point in November of 2021, it's now 51 points below. And I simply point this out because who is in market, who may be coming to your dealerships may be changing, since we would assume that pretty much only folks who are optimistic or feel the economy's on a good path are going to be willing to take out a $40,000 or $50,000 car loan to get a new product. And folks who don't see the economy that way are probably going to be more reluctant to do so. So that's just one of the underlying factors that we're dealing with here as we try to recover from this terrible COVID crisis. So here's what we're looking at the vehicle market. This is looking at the monthly sales SARs. These are the official numbers of the Bureau of Economic Analysis puts out of what the seasonally adjusted rate, what was the pace of sales on an annualized basis. And this is really the roller coaster that we were on this year. You can see that back in March, April, and May, we saw SARs of 17.6 million and 18.3 million and 16.9 million. Combined, that March, April, and May time period was the best 3 months of sales pace in this market going back to 2005. So really just a phenomenal pace in the early spring. But then this chip shortage and the supply shortage really started to bite, and the sales pace has been in decline since then. We saw a bottom, or at least an early bottom, in September when the SAR fell to 12.3 million. It's increased a little bit from there, but our most recent data point for November was simply a 12.9 million selling rate. At this pace, December may be the very worst month of the crisis yet. December is normally a very big selling month, but the constraint of the market right now is we're stuck at about 1 million units. If that's the case, we're on pace to finish somewhere around 14.9 million sales this year. But this December number, I think, is going to be one that we're going to get a lot of attention about because it's going to look particularly bad. And in fact, it may even be sort of a 12 or an 11 million SAR for the month. So here's the situation right now. The supply situation is bad out there and continues to be bad. Right now, this is a chart here on the left showing available supply. In red is available supply by week through 2021. In light blue is supply in 2020, and then in dark blue is 2019. And you can see the red line is far below what we had last year. This week, in 2020, a year ago, we have 1.8 million fewer vehicles out there on dealer lots and over 2.5 million fewer than we had in 2019. But because the market is so constrained, you can see on the right that the days of supply, how long this inventory will last, is essentially flatlining here at around 30 days. That we're at a point now that every vehicle that can come in is going to get sold. We're we're sort of at a minimum in terms of available supply here. It's completely constrained. And so the outlook for the market is really dictated for when they can restock the shelves, when can more supply be available. Everything that I'm reading and hearing suggests that the situation is going to get better. We know that some manufacturers have already sort of turned a corner. Ford, for example, is looking at much better supply situation than they had just a few months ago. But it's really going to be varied. Toyota, we know, has been facing a very significant crunch, although they announced today that they're expecting to have one of their biggest production months ever in the month of January. So they're figuring that they're going to try and catch up very quickly here in the first quarter. So we have to try and guesstimate what is the recovery pace. And this is the chart here is just showing you monthly light vehicle sales. And as I said, we're sort of stuck at around 1 million sales each month, or around 1,050,000. Can we grow that from here? And if we grow at a 1% pace up to a 4% pace, that sort of dictates what the year-end outlook will be. And at this point, we think we're going to see a fairly weak first quarter as the recovery starts to begin. But as we get into the second and third quarter, we think that we're going to see the supply really start to improve dramatically. And we think this is going to take us to a year-end finish of around 16 million sales. So we're going to finish close to 15 million in 2021, but we should rise to 16 million next year. That's our outlook as it stands today. But again, it's all contingent on these chips and if they can get that supply crunch figured out. I will say I sat in on a couple meetings this week with some other suppliers in the automotive industry. And one of the comments that was made there was they were very grateful that the chip shortage was happening because otherwise their issues, be it wire harnesses, lack of their ability to get resin for certain adhesive projects that they've got, that their issues would have been hiccups to the assembly line. So for many suppliers who are having their own supply issues, the chip shortage is getting all the headlines, and that's just fine with them. So when we look at the inventory situation for the different brands out there, we can see it's really quite varied. But Toyota and Honda and their luxury brands seem to be in particularly tight supply situation. At the other end, you can see you've got Jeep and Ram and Dodge. A lot of the Stellantis products appear to be in a better supply situation. They have a little bit more days of supply. And I think that's one of the interesting things that we're going to need to watch for here as we look at how sales changes. Are consumers loyal to the brand, or are they loyal to the product? If they can't find what they truly want to buy, will they settle for something else out there, or will they be patient? Will they order that vehicle? That's really one of the big transitions that we're seeing in the market right now, that we know there's much more ordering going on where consumers come in and order their vehicle and know they're going to have to wait weeks, possibly months for delivery, but that way they're going to get exactly what they want. And as I've mentioned before, I think this is one of the growing trends that we're going to see, that there'll be much more ordering and that we're going to see dealer inventories stay a little bit on the lean side. I think there's very little motivation to get back to 60 days supply across the country at all the dealerships. So when we look at vehicle sales and how they've performed so far this year, again, it's been quite varied for everybody, but I'm looking at year over year through November, so 11 months this year versus the first 11 months of last year. And if we had to declare some early winners, well, they're not even on this chart. I've got Tesla. They're up 62% over what they've done last year so far. They really had a phenomenal year. I think we can attribute much of that to the Model Y, which really saw some great volumes this year. But I left them off this chart because they really kind of dwarf everybody else. And they're a bit of an anomaly. You know, they're in this growth phase. Genesis, as well, as a luxury brand for Hyundai, they're starting from very, very small volumes, but they saw some nice increases so far this year. But if we had to talk about some of the more mainstream brands, Kia and Mazda have had a particularly strong year. When we look at the other end of the spectrum, you can see that Infiniti, Jaguar, Dodge, Chevrolet, they are all looking at sales that are down on a year-over-year basis. And in fact, Ford and Chevrolet in particular, of the largest brands, really were bleeding share through the first half of this year as the supply constraints that they were facing really decimated their truck sales in the spring, and they gave up a lot of market share. They've turned the corner since, and they're starting to come back a little bit. But we're in a phase now where availability out there is really going to drive what's happening in terms of market share. And so we've seen substantial changes so far, and we're going to see more through the course of next year. Just to kind of summarize what we've seen, and I know I've shown this to you before, but I think it really does kind of reveal some of the bigger trends regarding this chip shortage. And this is looking at market share by the different brands, the Asian brands, the European brands, and then the American three brands without Tesla. And you can see with the Asian brands, what they've done in terms of market share by month in 2021. They had a really big first half of this year. They really saw some fantastic gains in market share, but they've been giving some of that back in recent months. And that's because that chip shortage, where they were able to skate by in the first part of the year, what's starting to hit home now. And certainly for Toyota and Honda, their sales have started to suffer as a result. For the European brands, they've also seen a relatively strong first part of this year. Where they're entering into the month of December here, this is a big month for luxury sales and European brands in particular, but their volumes are way down. It'll be interesting to see. They may actually hang on to their share simply because the volumes are so constrained out there, and that luxury buyer does want to get out there and buy before the end of the year. Their share may actually hold up, but I think luxury volumes are going to be particularly hurt in this month of December because of the constraints. And then we can see the American brands. They gave up a lot of share, as I said, the first half of this year, but they're starting to regain some of that lost ground because the chip shortage has improved. I would expect we're going to see the American brands make some more gains here in 2022, particularly Ford, because they do have a couple of new products that are going to be coming out, and they'll be in much larger volumes that are going to be, I think, very helpful to their overall numbers. So when we look at market shares and what's been changing, I put 2019, 2020, and 2021 so we can get an idea of what are some of the trends out there. And I think one of the things we can see here is that Toyota is leading the market, and they're going to win the title this year as the best-selling brand in America. That's the first time Toyota has done it. I think we're going to see some interesting articles of what happened to America that we're not seeing Ford or Chevrolet up there. But really, they've just had a very, very strong year relative to the weakness that Ford and Chevrolet have done because of this chip shortage. Ford, as you can see in this chart, has given up shares. Chevrolet, but there's also some other interesting gains out here. Hyundai, in the middle of this chart, you can see has had a nice couple of years of market share gains, as well as Kia. And then on the far right, you can see Volkswagen and Mazda also seeing some very modest gains. But in these turbulent times, I think that those brands in particular can feel good that they were able to gain in this environment. And then when we look a little bit deeper at some of the luxury brands, a very interesting trend emerges here. You can see Mercedes-Benz, they still lead, and this is year to date so far in 2021. They're still the top luxury brand by a hair, but I think Tesla's going to take the title when the sales are counted up at the end of December. And you can see Tesla's been gaining massive ground on market share here over the last couple of years. And even though the other luxury brands have done fairly well, Tesla's really grabbed a huge chunk of market share. And I think what's going to be interesting here for 2022 is whether Tesla can maintain that share. And I'm going to be talking more about this in just a moment, but there's a lot of competitive products that are going to be coming. Ford's F-150 Lightning, for one, which really could be a game changer, the electric pickup truck. So I think Tesla has had a really kind of a smooth sailing period because they haven't had a lot of competition out there. But that's going to change this year. And in fact, we have two more competitors entering the market, and that's on the far right. We have Polestar coming from Volvo, their electric vehicle brand, and then Rivian is finally going to be hitting the market. So we're not expecting to see big volumes from them in 2022, but certainly it's just going to be adding more competition for Tesla. And then we can see the different segments here. I just pulled out some of the largest segments. On the far left, we can see mid-size SUV crossovers. They're the top product choice in the market today. They were last year as well, and they built upon that lead in 2022. But we can see where market share is dropping is compact SUV crossovers, which is a little bit surprising, except that we can see that subcompact SUV crossover is actually gaining in share. So it may be folks that are looking for a small crossover are actually looking for an even smaller crossover because it probably has a better price point for them. And so we're starting to see some growth there. A couple other segments I think are worth just pointing out. is the electric vehicle segment. You can see that that made good gains this year. Again, much of that is on the back of Tesla, and I said before the Model Y, but I think we're going to see electric share continue to grow in this market going forward, and that's just going to be one of the changes for 2022. That electrics are going to be in the serious realm of consideration for many buyers instead of just being a novelty type product. And one of the big issues that we're seeing in the new market is average list price rising rapidly. And that's what this chart here on the left is showing. This is showing the list price. There's always a little peak at the year's end. That's what we can see here in the month of December as the new models come into the market and the old models are sold out. We see prices on average rise. Well, this year the old models are all gone. The only thing that's coming in are the new models with the higher price points. And so the new vehicle prices have just been rising rapidly. And in fact, you can see on the right, this is the year-over-year change in weekly list prices. And they're still rising at above a 12% rate. And so this is what the inflation is that a lot of folks are concerned out there, that vehicle prices are certainly rising faster than incomes, rising faster than household wealth. And so I think there's real concern out there that this inflationary environment we're in may transition vehicles from being a vehicle in every American's garage to being a luxury product for all Americans, that only some Americans are going to be able to afford these products. That's certainly a transition we've been going through, and that's a transition that's been continuing and accelerating in this post-COVID market. The other thing we're seeing out there is that this tight inventory environment is not all bad for the manufacturers, and we know certainly for the dealers because they've been reporting very strong profits. But we've seen incentives as a percent of transaction have fallen dramatically. The manufacturers don't need to provide quite the incentives that they had before to try and move the metal. That's why I think that there's going to be a real struggle within these manufacturers is how lean and mean can they stay? Can they stay in this tight inventory environment throughout 2022 and into 2023 so that they can keep incentives low, so that they can keep transaction prices high and sort of maximize profits as much as possible? That's going to be the real challenge. Will the industry stay lean and mean, or are they going to get too many products out there and have to do discounting yet again? That's something that we're all going to have to watch. With these prices rising, though, one of the things that's really been one of the key mitigating factors for the vehicle market has been 0% financing. We know there's been a lot more purchasing out there in this environment, that there's been a pullback on fleet activity from the manufacturers, and there's been a pullback on leasing. Leasing as a share of the market has fallen by a couple of percentage points post-COVID. And part of that is because there's such a good deal to be had, relatively speaking, in buying a vehicle because there is a tremendous amount of interest rate subvention going on. This is showing the percent of loans out there for purchases that have a 0% interest rate. You can see this really spiked during the worst of COVID, and it's starting to trend down from there, but it still remains elevated relative to what it was prior the crisis. So this means that leasing on a relative basis is maybe a little bit less attractive to many folks out there if they can buy. And also the manufacturers themselves are a little bit less inclined to push leasing in this environment. And so when we look at the monthly payments, this is a chart that's showing what the average monthly payments are so far this year. And you can see that overall the trend is that the monthly payment for someone who's purchasing a vehicle on loan is spending $583 a month. If they're doing it on lease, it's about $500 a month. And if they're doing a used vehicle, you can see that's risen dramatically to $451 a month is what the used payment is. And these payment differences are really kind of what kind of steer consumers into the new market relative to the used, or into the lease market relative to the used. Because many folks are going to be shopping at where they can get the most value as they perceived it. And what we can see here is that leases as a cost over used market is actually fallen back to 2014 levels. It's only about $50 higher to get a brand new lease vehicle relative to what you're going to have to pay for used. So I think that that's going to help spur more interest in leasing next year because it provides a relatively better value if you're going to get a brand new vehicle. But it may be that there's just not going to be a lot of product available to meet that demand. And so we're at an interesting time where I think there's consumers are going to be interested in leasing, but it may not be available for them to do it. Affordability in general, I know I've showed you this slide before, but I do want to just point out that we are seeing that a big transition in the industry where we're really abandoning the lower price points in the market. This is a chart that's showing market share for the different price points in the market. And the key takeaway is that in 2012, and this is annual data going back to 2012 through 2021, in 2012, 54% of the vehicles sold had an MSRP below $30,000. In 2021, that's fallen to just 21% of the market. It's a much lower pace. And what we're seeing is that we're moving to much higher price points. And you can see, the $50,000 to $60,000 category, just a few, little bit of market share, about 3% market share back in 2012. It's rising close to 20% of the market now in 2021. And 60,000 plus, I mean, again, that's rising as well. And so who's out there buying is changing rapidly, but it's also changing the manufacturers. And I pulled this chart together because I thought it was interesting to look at if we divide the market into sort of luxury prices and non-luxury prices. And I chose the $50,000 MSRP. What was the market share of the $50,000 plus market back in 2012? And what's the market share of the $50,000 plus market in 2021? And the key takeaway here, as you can see, back in 2012, Mercedes-Benz dominated the most expensive vehicles out there. They had 18% of the market for vehicles where people were going to spend over $50,000 on a vehicle. But what you can see in 2021 is that their market share has fallen dramatically, and you have some new players into this market. Look at the move that Ford is now making. They're moving their product set into a much higher price point. And then on the far right here, you've got Jeep and Ram. They used to not have products at this price point. Now they have a sizable portion of their portfolio is going to be selling in this market. So I simply wanted to point this out because I think we have to reconsider what is luxury, because it simply can't just be the brand, because a lot of folks are spending big money on vehicles that certainly I think they could have bought any other number of products, but they chose whatever product that they did. And so the environment for luxury as defined by these high price points is getting even more competitive. And I think that's a trend we'll see in 2022. When we look at the non-luxury prices, what is the market share for the market less than $50,000? You can see that Ford used to dominate this market with close to 16% market share. Now they have just 9% of the market. And it's really Toyota and Honda who have really gained in the lower price tiered product set, as well as Subaru. They're in the middle. So again, I just wanted to point this out, that when we think of the broader market, we may start seeing that some of the manufacturers are trying to steer themselves into different price points to try and hit more consumers. So let's talk briefly about the used vehicle market and some of the inflation we've seen out there. The used vehicle market has actually been very, very robust. Vehicle sales are going to be about 40.9 million total used vehicles this year. That's going to be close to a million more than we did back just prior, back in 2019. So, and more than we did last year. So the used market has been looking very, very strong, even though we have these high prices. But the outlook, I think, is looking a little bit more muted for the used market as we look forward, in part because of these high prices. It's going to force a lot of people to not be able to participate that might have been buying in the used market otherwise. And of course, in 2022, we're not going to have all of that stimulus money that we've had over the last 2 years. Those government checks, they're not coming anymore, at least in the size they were before. That was a real stimulus towards used vehicle demand that we're just not going to have this year. But you can see here that list prices continue to rise. We're approaching $28,000 now for the average list price of a used vehicle. And on the right here, this is the weekly year-over-year change in that list price. When people talk about inflation, this is exactly what they're talking about. We're looking at year-over-year prices above 25% growth. That's, that old college vehicle or the high school product that you wanted to get for your son or your daughter. It's gotten significantly more expensive. And this is, I think, a new reality out there. And just to give you a taste of how crazy it is out there, I pulled a used Volvo just to give you an idea. And on the left here, this is the prices of an S60 used Volvo by model year. So in light blue is the model year 2016, in dark blue is model year 2017, and then in orange there is model year 2018. And this is going back to January of 2019, and you can see that there's sort of a normal depreciation of these vehicles. They're older, the new products coming in, there's always been sort of a normal depreciation of these products. But what we can see is that once COVID hit and the inventory disruptions happened, you can see that we disrupted this normal depreciation. And then when this chip shortage really started to bite in the spring, and availability of any products, new or used out there, really started to dwindle, the value of these vehicles started to rise tremendously. And you can see that this S60 actually started to appreciate value over the last 6 months and defying gravity. A depreciating asset appreciating in value. It's really quite remarkable. And on the right here, I just pulled the XC90 just to give you another taste, because you can really see sort of clearly the normal depreciation patterns, and then how crazy the product has been in this post chip shortage environment. Now the volumes are incredibly small. That's one of the things that happened early in this crisis, that a lot of the old good inventory got picked through pretty quickly and sold quickly. So the volumes on this is small, but even still, it does reflect really just the craziness of the values out there. And all of this is having an impact on retention values. This is showing what we are able to measure from our Mannheim auctions, as well as at Kelley Blue Book, of what is the retention value of essentially a 3-year-old vehicle that comes to auction. And in dark blue is sort of the normal depreciation. It comes back to auction in January at about 60% of its value after 3 years old. And then by the end of the year, it's worth about 52% or 53% of its value. It depreciates through the course of the year. In light blue, you can see what happened last year during COVID. We more or less started the year normally, and then COVID struck, and it really started to appreciate. We saw retention values shift to a much higher level in the summer of last year. And then when this chip shortage hit in the spring of this year, you can see that red line. We've actually just seen these crazy retention values. But this means that there's a tremendous amount of equity out there in vehicles, where if anybody's trading in a vehicle, they're going to be able to get much greater value on that vehicle. And I think a lot of consumers aren't aware of that. And so they're going to have to be either woken up to it or taken advantage of. But I think the word's getting out there more and more. And there's going to be a tremendous of opportunity with these guys as we look into 2022. This is showing monthly lease maturities that we've had in history. And then in light blue here is the monthly lease maturities we're expecting in 2022. We're expecting about 3.9 million off-lease vehicles coming back this next year. The vast majority of these are going to be in the money, have that built-in equity. So I think there's going to be real opportunity here, and it's going to be very competitive, as I'm sure you're well aware, to try and get consumers to pull these vehicles into your dealership, because everyone's going to want these things. I will point out one of the reasons that it's going to be a real important to do this effectively this year and really try to maximize these potential customers is that it's a much smaller pool in 2023. We're expecting only about 3.3 million lease maturities in 2023, and that's because the bad year we had in 2020. Well, that lack of volumes is going to start to hit here in 2023, and so it's going to these off-lease vehicles are going to get even more competitive. So lastly, I just want to finish up by talking about electric vehicles, because this is one of the exciting things for 2022. I think this is going to be a big year for EVs. As I mentioned before, we've talked about EVs for many, many years. The media loves to talk about these things. But as we all know, consumers, for the most part, aren't really that interested in these things. But I do think that's going to change this year. And one of the big reasons being that there's going to be a tremendous amount of new products coming to market, as well as all of the talk around these vehicles within what the new administration has been proposing for some of its big policy initiatives. Just looking at what the share of the market has been for hybrid electrics and battery electrics, you can see that during the COVID crisis, the market share of these products has actually done quite well. It's really improving during this period. And I think, as I said before, consumers are starting to get more and more interested in these products because there's more to choose from. And certainly the expansion of charging stations is going to help support that as well. But one of the things that's going to happen in 2022 is a lot of the initiatives that the Biden administration has talked about since they came to power are actually going to start to come to fruition. We did pass the Infrastructure Investment Act last month. $1.2 trillion of spending is going to happen. There's going to be an immediate $110 billion starting to be spent on new roads and bridges. So we should see a lot of construction activity, a lot of orange cones as we get into the spring. An additional $40 billion for bridge replacement and repair. And in that bill, there's another $7.5 billion for EV infrastructure. So they're going to start offering all kinds of grants for charging stations around the country. It's well below what's been estimated is needed, up to $50 billion to get to the 500,000 you've talked about. But certainly this is a step in the right direction. The other bill that's coming is the Build Back Better bill. And actually, I think the Senate or whoever's in charge, the administration or Chuck Schumer has decided maybe we have to shelve this bill for now because it doesn't look like we're going to be able to pass it before the end of the year. But within this bill is very specific programs that could really be beneficial to the EV market here. This is where there's talk of that $7,500 subsidy for electric vehicles, and those who have used up their EV subsidies, like Tesla has, would be grandfathered in. They'd get to start from zero again. And they're going to offer a $500 bonus if the battery in that vehicle comes from the US. And there's talk of offering a $4,500 bonus if that vehicle is assembled in the United States with union labor. Now, clearly, these are very politically charged initiatives to try and put in this bill. It's still in the negotiation stage, but it does offer a significant, $12,500 on an EV. That could be a significant amount of money to move the needle for a lot of people. But it's only for vehicles, cars parked, MSRPs less than $55,000 and trucks less than $80,000. So that would leave some Teslas and other of these higher priced vehicles out in the cold. And it does phase out for higher incomes. But these are some of the programs that are coming, all of which are going to help stimulate EV activity. We go by IHS's forecast of electric vehicles, of what they expect. We don't have our own outlook. But this is what their forecast is. They're expecting to see by over the next 10 years, we're going to have 3.5 million electric vehicles sold in this market by the end of the next decade. So there's a tremendous amount of growth that's expected in these markets, in this product segment. The 500,000 charging stations that President Biden has talked about is not just a nice to have, it's a need to have if this is the type of vehicle sales growth that we're expecting to see. And it's going to be necessary because these home charging systems are very expensive. It's tailored more towards wealthy people. Even the very idea of having a garage, only wealthy people have a garage. Most homes in America don't have a garage. So, already you get into difficult ground in terms of trying to make this a product for the common man. And there's still a lot unknown regarding electric vehicles. The residual values. With technology moving so quickly, how stable are these residual values? And what is the residual value of an electric vehicle that gets 100 miles or 150 mile range when the next 2.0 version or 3.0 version of that vehicle is getting 2 or 3 times that range? That's something that could change dramatically. Battery technology is still yet to be decided. We're asking consumers to make investments in these vehicles, and many are going to own these vehicles for 10 years or more. The technology, though, hasn't even been decided yet. In many ways, I think if I told you you're going to get the next iPhone you get, you're going to have to keep it for a decade. You may be really reluctant to dive in to get that technology. You might want to wait until the very latest and greatest technology is available. And also, of course, cold weather usage. We talk a lot about electric vehicles, and they're very popular out in California and the West Coast. I can tell you here in Michigan, electric vehicles don't get near the range in cold weather than they do in warm weather. And we've had many stories written in the paper of winter freezes coming through, and a lot of electric vehicle owners being stuck on the side of the road because they didn't get the range that they were hoping to get. And as I mentioned before, I think the F-150 Lightning is going to be one of the big stories of 2022. Ford has already gotten 200 initial pre-orders of that vehicle, and it's been so popular that they're not even going to take any more orders for next year. All of the production for next year has been spoken for. So the big reason I think this is important is because for many, many years, the idea that, a pickup truck driver would ever buy an electric vehicle, preposterous. Well, Ford may be proving that wrong, that people buying sort of traditional type vehicles, gas engines, may be more than willing to buy electric vehicles as long as they can perform and meet the needs. And I think the F-150 Lightning may go a long way towards mitigating a lot of concerns that consumers have about these vehicles. Lastly, I just want to point out that we talk a lot about adopting electric vehicles. Should we be prepared for these? How much do we support this with government money? I think all of that's a worthy debate, but I do think we have to keep in mind that if America does not support an electric vehicle market here in the United States, we risk becoming a within-region market. The products sold here are only going to sell in the U.S. market, and we won't be able to manufacture and design products in the U.S. That can sell in other parts of the world. And I think that's a real danger here, that we want to stay competitive on the global stage. We have to make the commitment, because China and Europe are well on their way towards making their own commitments. But when we look about the long-term outlook for EVs, as I said before, this is showing what market share is of EVs. And I think we just have to keep in perspective that even if we grow to 3.5 million for electric vehicles, that's really only going to be about 20% of the market at the end of 10 years. Hybrids are still going to sell almost 1 million more vehicles than electric vehicles. And we never see hybrids and electrics combined overtake gas engines. And this is according to IHS's own forecast over the next decade. So we have all this talk about electric vehicles, and certainly they're coming, and they're going to be an important product segment, but we're going to have gas vehicles for a long time yet to come. They're not going anywhere. Consumers still like these products. So don't be fooled by all of the attention that electric vehicles are getting. It's certainly important, but consumers still like their gas vehicles as well, and they're going to be a dominant part of the market here over the next decade. And when we look about the change of the vehicle park itself, it's going to take years to get the vehicle park, the number of vehicles in the U.S., to become an electrified vehicle fleet. Right now, there's 277 million vehicles on the road here in the United States. Only a fraction, 1.2 million, are electric vehicles. 99.5% of the vehicles out there are use gasoline to operate. The average vehicle age in the U.S. is 12 years of age. And even when we look forward with EVs, as I said, they're only going to be become about 3.5 million here at the end of the decade, selling each year. They're still going to remain a very small fraction of the overall vehicle fleet. And so, we just have to keep in mind that this is going to be a very long process to try and electrify the American vehicle fleet. Let's not get fooled that EVs are going to take over the world, within weeks, within years. It's going to be a very slow transition to make this happen. But it is a transition that's going to happen. It is going to happen. I have no doubt that we will transition to these products. But again, it's going to be a very slow pace. And I do want to make one last point here on this page. I do think it's kind of important when we look at the crisis that we're in today with the microchip shortage and how disruptive that has been to the vehicle production around the world. We also have to think about the replacement chips. When we think about these 277 million vehicles on the road, you can see that a huge portion of these, almost 75 million of these, are just less than 5 years old. Another 75 million are less than 10 years old. All these products have chips in them. Some have a whole bunch of little electronic chips. Some just have a few electronic chips. But certainly, as the technology advances on these products, more and more computer chips will be involved. Will we have the chips available to fix these products 5 years, 10 years from now? Will they be backward compatible? We know that your air pressure monitor system uses its own very specific type of computer chip. Will 10 years from now, when you have to fix that vehicle, will you be able to get a chip to replace the one that needs to be replaced? I think that's something that the industry is very vulnerable with as this technology expands, and as vulnerable as we are to this supply chain. Will the replacement parts be in there to keep everything running smooth in the future as well? I think that's something just to keep an eye on here in 2022 and beyond. So overall, I just want to say it's been I think a very interesting year for 2021. I think the vehicle market's held up remarkably well given the craziness that we've been dealing with. But I think we should take solace in the fact that 2022 does look to be a better year, that we were all sort of naively hoping that COVID would come and go quickly and that we wouldn't see long-lasting ramifications from it. Well, I think we know that that's not going to be the case, but we still appear to be on the right path, and that is a stronger vehicle market in 2022. So with that, those are my comments, and if there's any questions I can address, please feel free to drop me an email, or be happy to communicate with you if you have any issues with something I've presented today.
Charlie, thanks so much for joining us for our last webinar of 2021. We really appreciate and value what you have to say, and we've loved having you on throughout the year. I'm sure we'll be seeing you more next year. Again, you will all be receiving a copy of this webinar early next week. To those on the line, thank you. Listeners, old and new, thank you. Your presence means a lot to us, and we can't wait to bring you more exciting programming in the new year. Take care, everyone, and happy holidays.